As Casey mentioned, my name is Bobby Labadini with John Hancock Investment Management. We're a very large firm, but I and Matt Miskin, who's also on the call, we represent the asset management side of things for our firm. So think our investment products like mutual funds, ETFs, separately managed accounts, private assets, 529 plans as such. And in my role, I'm based in Cincinnati, Ohio, and I work with great financial advisors like Casey in really kind of three main capacities. Number one, providing different economic insights that we get from our various portfolio managers, market strategists, and economists that I have the pleasure of being able to interact with, and gathering all that information and sharing those insights with Casey when I meet with him. Number two, educating him on the different investment solutions that we offer to help you all reach your long-term financial goals. And then number three, which is what I enjoy the most, is providing educational content, which is really what the goal of today's virtual meeting here is. And I couldn't be more excited to be joined by Matt Miskin, who's our co-chief investment strategist with John Hancock Investment Management, and is key in providing the different market insights that we develop and distribute to our financial advisor partners. And Matt has the luxury of having access to all the different asset managers that we work with. And so for Matt here today, what he's going to be providing is an economic update and kind of market update on what he and his team is seeing over the next 12 to 18 months. And as Casey mentioned, we're happy to answer questions along the way. So again, thank you so much for joining us here this afternoon. I'm going to pass things over to Matt. And Matt, thanks again for taking time out of your day to join us.
Thanks, Bobby, and thanks, Casey. Thanks, everybody. All right, so let's just first go over the economy. We are seeing the U.S. economy be amazingly resilient. And what I mean by that is there was this call for a recession in the U.S. economy years ago, a couple of years ago. And the Federal Reserve had just raised interest rates, mortgage rates went up, and the thought was that was going to slow down the economy. And lo and behold, the U.S. consumer has barely flinched. Excess savings from COVID has helped out. Wage gains has helped out. The market's helped out. But what we're seeing across the country right now is the Midwest is actually carrying the U.S. economy. And when I talk about, either Central America, Middle America, however you want to put it, but what we're seeing is a manufacturing renaissance in the United States. So companies from all over the world have come back to the United States to do business. And we are seeing investment in semiconductor production. The CHIPS Act is part of this, but it's also we're seeing an industrial build out in the country. We've got energy independence. So we produce so much oil in this country that we actually ship it. We sell it to the rest of the world. Well, oil prices have been elevated, and we're actually lucky that we have the oil and energy resources we have. That is piped up into these manufacturing hubs, and that's been booming, frankly. When I go across the coasts, the Southeast is doing well. The West Coast, California, isn't doing so hot. Frankly, California is struggling. It's got of the highest unemployment rates in the country, the worst real estate market in the country, and the cities aren't doing as well as they once did. Frankly, we saw a lot of migration out of the cities during COVID into more suburbs or more the Midwest, Central America. And people said, I can work remotely. I love the quality of life here. I've got internet access. I can do my job out here. So the cities have been struggling, but what we've seen is that the U.S. economy overall has held up really well. We are seeing a bit of a slowdown relative to where we were, the end of last year. The economy was growing at 4%. To put that in perspective, that's like China's growth. And there was this whole call that China was going to catch up to the United States. That hasn't happened. China is actually struggling. Economically speaking, they have 60 million units of unsold houses there. You could basically house all of Canada in excess houses in China right now. And they have all this excess real estate, and it's just dragging their economy. As I think about the global economy, also, I just want to hit a couple more. Europe's doing better. Europe has been booming with tourism. So either I think it's from the United States, but we're seeing a lot of people travel to Europe, vacation to Europe, and that's helping their economy because when people go there, they spend money. They do a lot of, they they buy a lot of things. Luxury goods is typically more European oriented stocks, but that's just been doing better. But China's doing a bit worse. The US is of the best in the world. So globally, when I look at the economy, I see the US doing the best. That's where we're seeing the most opportunities. Frankly, it's the Midwest that's doing much of the heavyweight or heavy lifting. But I just kind of want to talk about the markets as well. So, that's the economy overall, pretty good, not bad. But in terms of markets, there's one thing that drives the markets crazy, and it's called inflation. And frankly, it drives us crazy too, right? We don't like going to the grocery store and being like, really, this is the price of this still? But that's been the biggest issue with the market. And inflation is coming down, but it's taking time. And it's interesting. The biggest driver of inflation right now is housing. And the best housing markets in the country are the Midwest. Detroit actually has one of the best housing markets. Ohio's got great housing markets. The Southeast has great housing markets. But housing prices haven't come down. They've stayed elevated. In fact, they're up about 4% year over year, national housing prices. And that feeds into inflation. And so we're at this weird juncture where the market wants inflation to come down, but the housing market's very strong. And so we're getting there. It's just taking time. Now, the market is still near all-time highs, the S&P 500, much of the equity market, even European markets are at all-time highs, meaning they've never been higher in history. Now, some of them are a bit overvalued. Some of the tech stocks, there's a couple tech stocks that have done a lot of the heavy lifting for the market, meaning because of them, the market is up to where it is. These tech stocks are getting a bit overvalued. You want to make sure you've got a broader portfolio of opportunities because I know, if you look at, hey, what's doing well and you see just the tech stocks, it makes you want to just own the tech stocks. That's typically not the way you want to do it. A lot of times when the best performing thing is at the top, that ends up taking its turn and falling behind and something else does better. We actually see mid-cap stocks as a great substitute for large cap tech stocks. These are cheap stocks. The way to think about stocks is just like you're thinking about buying a house or a car or anything, is you want to look at how has it been priced over time? Is it cheap or expensive? Right now, if you take out some of those big tech stocks in the market, it's actually pretty cheap. But some of those tech stocks are expensive. We're looking at other opportunities across equities right now. Earnings are up about 6% year over year on the S&P 500. They're forecasted to be up 10% this year overall. That's good. I mean, stocks follow profits. If you were to take out all the noise, all the CNBC, all the news, and you were to just be an investor and focus on one thing, I would focus on corporate profits. At the end of the day, if a company makes more money over time, and that's what you are as an investor long-term in the equity market, you are investing in these great businesses that grow earnings over time. They pay dividends. They have great cash flow. They've got good balance sheets. That's how you accumulate wealth. And right now, earnings are growing. So that's driving the overall stock market, is these good corporate profits. I just want to end with the bond market. So I've been doing this for 20 years. And majority of my career, interest rates were basically zero. And it was tough, frankly. If you wanted to buy income, if you wanted income, it was hard to get. You had to go into dividend paying stocks. You had to go somewhere else. The bond market now has income. We're looking at high quality bonds that yield about 5%. Now I know cash yields about 5.5%. Or money markets or certain CDs, but those yields can drop. They can fluctuate. If you have a short-term investment in a T-bill or some sort of cash-like investment, that can go down or up depending on what the Federal Reserve does. So it's more variable. We're looking at bonds that, and you don't have to go far out in terms of the bond market. You don't have to go later maturities, but just even incrementally looking at bonds right now, you can lock in 5 to 6% yields for years to come. And we are looking at the bond market. There's been some volatility. It's not easy. Sometimes the best investments are things that don't feel great, because that's often when the best value is. But in terms of the bond market, we are seeing opportunities. The Federal Reserve raised interest rates, and that's a good thing for bond investors because that means now we've got income. We've got bond income. So we like the bond market as well. We're seeing opportunities there. We just don't need to take a lot of risk there right now, because we're getting high quality income. But overall, in some ways, this is the most hated bull market I've ever seen. I've never seen the S&P 500 at all-time highs, the bond market offering 5%, 6% yields. And you know what the most popular investment was last year? Cash. So everybody, that has just that doesn't have a financial advisor that helps them manage their portfolios, a lot of them went into cash. And they sat there and the stock market was up 20%. The bond market was up 6%. Cash didn't do bad. It was up 5%, 4%, but cash isn't going to be a long-term investment. And what we're seeing is the sentiment is pretty negative, meaning the last time the S&P 500 was all-time highs and had just gone on a great bull market, it was the tech bubble. People are like, I want to buy this tech stock. I want to buy this. I want to buy that. We are seeing very little euphoria in the market. People are not screaming to get in the market. In fact, they're buying cash. They're holding it in cash. There is $6 trillion sitting in cash. That's just in money markets. If you did bank accounts, it's $22 trillion. Think about that. That is the size of the US economy, is $22 trillion in a year. There is tons of money still sitting there. And in our view, that money's going to move. It's just going to be when interest rates come down and people say, oh my God, my money market or CD or, my bank account even that actually pays something, that's coming down. I've got to put this money to work. We don't want to wait until the Federal Reserve starts cutting to put the money to work. You want to make sure you're ahead of that, thoughtful about it. That's why it's great to have a financial advisor that works with you about this, because we're seeing, it's classic investor psychology. When you buy high, sell low, or you're in cash, and then you start wanting to put it to work at the worst time. You want to be thoughtful about this. You want to be a long-term investor, and have a balanced portfolio. It's for us, it's kind of funny to watch the media around this. Every time that someone says that, a balanced portfolio is broken, or they call it the death of it, the next year it comes back, screaming back. 2022 was a tough year for stocks and bonds. 2023 was awesome. And what we've seen almost every single year of this cycle is a different market has led. 2021, it was small cap stocks. 2022, it was value stocks. It was energy stocks. 2023, it was technology stocks. This year, emerging markets, and China's doing a bit better. But that's why you want a diversified portfolio, because every year it almost seems like it's a different leader of the market. And you want to have a little bit of exposure to all, so that every year you're not saying, okay, I want to buy that thing that's up, and I want to sell this, and buy this thing that's up, sell that. No, that ends up you just churn your account. It doesn't work out. You want to be balanced in a portfolio. So those are my big thoughts. In perspective. There is an election this year, I think. So I could talk about that quickly, just to address it before the Q&A. So in terms of markets, anyone want to guess what the best performing part of the market has been since the Biden administration has been in office? It's a trick question. It's energy. It's oil. It's drill, baby, drill, Texas oil companies. And if you had told me at the beginning of the Biden administration, now he comes in, he's like, we're going to do alternative energy. We're going to support them. We're going to write letters, to the energy companies saying you should just lose money and give us all oil. It doesn't work that way. It's the private sector, which means the hardworking families of the United States, that drive the economy. And it also matters when you buy. Back then, it was coming out of 2020, oil prices were low, energy stocks were cheap, and they've rebounded under the Biden administration. Under the Trump administration, the top performer was technology stocks. In the top 10 was Chinese stocks. So under the Trump administration, tough on China, throwing on tariffs. It's been interesting. Those didn't get repealed either. Those were kept throughout the whole next administration. But what we saw was the market was completely different than what you would have thought given Trump's policies. So policies don't mean the same thing as the markets. The government makes up less than 10% of the economy. And that is now. It's usually it's less than 5% historically. We just had the greatest intervention of the government in modern history, other than World War type periods, because of COVID. In our view, that is over. We have moved on. That was a once in a century type event.